Most young investors think successful investing means finding the next Nvidia, Tesla, or some hidden stock that's going to explode overnight. And because of that, millions of people spend hours scrolling through finance videos, stock tips, Reddit threads, and social media trying to build the perfect portfolio. But what if the smartest investing strategy was actually the simplest one possible? What if instead of constantly chasing stocks, checking charts every hour, and stressing about market crashes, you could build an entire portfolio with just one ETF, one investment that already owns thousands of companies across the world, from Apple and Microsoft to Canadian banks, healthcare companies, factories, energy businesses, and emerging market giants. That's exactly why ETFs like iShares Core Equity ETF Portfolio, Vanguard All Equity ETF Portfolio, and Vanguard Total World Stock ETF have become incredibly popular among young investors, especially those who want long-term wealth without turning investing into a second full-time job. The truth is, modern investing has become overwhelming. Every day, somebody online is telling you to buy a new stock, panic about a recession, sell because of inflation, buy because of AI, or invest in some once-in-a-lifetime opportunity. And for beginners, this creates decision fatigue. People become so focused on trying to outperform the market that they never actually start investing consistently. And that's where all-in-one ETFs changed the game. Instead of trying to predict which company will dominate the future, these ETFs simply buy almost everything. They spread your money across entire economies, industries, and countries. Think of it like this. Instead of trying to pick the winning player on a sports team, you own the entire league. Now let's start with XEQT, because this ETF has become one of the most talked about investing options for young Canadians. XEQT is essentially designed to be a complete global stock portfolio inside one ETF. When you buy XEQT, you instantly own exposure to thousands of companies worldwide. Roughly speaking, around 45% of the ETF is invested in the United States, about 25% in Canada, around 22% in developed international markets like Europe and Japan, and the remaining portion in emerging markets like India, Brazil, and Taiwan. What makes this interesting is that you are not just betting on one country or one sector. You're betting on the global economy itself. The United States remains the largest part of XEQT because America still dominates global business and innovation. Companies like Apple, Microsoft, Nvidia, Amazon, and Google represent massive parts of the global market, which means XEQT naturally has strong exposure to technology. But it doesn't stop there. The ETF also holds financial companies, industrial manufacturers, healthcare giants, consumer businesses, railways, telecommunications companies, and energy corporations. This diversification matters because nobody truly knows which sector will dominate over the next 20 years. 20 years ago, people thought oil companies would dominate forever. Today, technology leads the market. Tomorrow, it could be artificial intelligence, robotics, healthcare, or industries that don't even exist yet. XEQT is built on the idea that instead of trying to predict the winner, you own all of them. One of the biggest advantages of XEQT is simplicity. Young investors often underestimate how powerful simplicity can be. When markets crash, complicated portfolios create emotional stress. People panic, overreact, and sell at the worst possible moment. But a simple, diversified ETF reduces the temptation to constantly make emotional decisions. Another major advantage is automatic rebalancing. You don't need to manually adjust international exposure or sector weights because the ETF does it for you internally. And then there's the cost. Compared to many mutual funds charging high management fees, XEQT remains relatively low cost, which matters far more than most beginners realize. Even a 1 or 2% difference in fees can compound into thousands or even hundreds of thousands of dollars over decades. But XEQT is not perfect. One of the biggest downsides is volatility. XEQT is 100% equities, meaning there are no bonds to stabilize the portfolio during market crashes. If the market falls 20 or 30%, XEQT will likely fall significantly too. That level of volatility sounds easy to handle when markets are going up, but emotionally it becomes difficult during recessions and panic periods. Another downside is its large US concentration. While many investors love American market exposure, some people may feel uncomfortable having nearly half their portfolio tied to the United States economy. Now let's move to VEQT, which is very similar on the surface, but has subtle differences that matter depending on the investor. VEQT also gives you global diversification inside one ETF, but compared to XEQT, it has slightly more Canadian exposure. Roughly speaking, VEQT allocates around 30% to Canada and slightly less to the United States compared to XEQT. At first, this may not sound like a big difference, but it changes the personality of the ETF. Canada is heavily weighted toward financials, energy, natural resources, railways, utilities, and telecommunications companies. So VEQT tends to have stronger exposure to sectors like banking and energy than many US-focused portfolios. Some Canadians actually prefer this because they feel more comfortable investing in businesses they recognize and economies they understand. There's also the concept of home bias, which means investors naturally prefer companies from their own country. In moderation, this can actually make emotional investing easier because people feel more connected to the investments they hold. VEQT still has strong exposure to American technology giants and global companies, but its higher Canadian allocation creates a different balance. The pros of VEQT are similar to XEQT: simplicity, diversification, low maintenance, automatic rebalancing, and strong long-term growth potential. It is designed for investors who want maximum stock exposure without needing multiple ETFs. But VEQT also carries similar risks. It is still 100% equities, meaning market crashes will affect it heavily. And some critics argue Canada represents a relatively small part of the global economy, so overweighting Canadian stocks could reduce long-term growth potential if the US market continues outperforming internationally. This brings us to VT, which many investors consider one of the purest forms of global diversification. VT, or Vanguard Total World Stock ETF, is essentially designed to own the world. Unlike XEQT and VEQT, which are created specifically with Canadian investors in mind, VT follows global market capitalization more directly. This means the allocation changes naturally based on the size of economies and markets around the world. Because the United States dominates the global stock market, VT still holds a large percentage in American companies, but it also spreads exposure broadly across international, developed, and emerging markets. When you own VT, you own thousands of companies globally in a single purchase. Technology remains the largest sector because the world economy itself is increasingly technology-driven. But VT also includes healthcare, industrials, financials, consumer sectors, energy, and transportation companies across multiple countries. One of the biggest advantages of VT is its neutrality. It doesn't strongly favor Canada, Europe, or any single region beyond what global markets naturally represent. In a way, VT reflects the modern world economy itself. If India grows rapidly over future decades, its representation rises naturally. If Europe weakens economically, its weight falls naturally. This makes VT extremely appealing for investors who believe global diversification is the safest long-term strategy. Another advantage is simplicity. Many experienced investors eventually realize that most active stock picking underperforms broad market investing over long periods. VT embraces that philosophy completely. But for Canadians, VT also comes with disadvantages. Because it trades in US dollars, Canadians must think about currency conversion costs and exchange rates. There are also tax considerations, especially regarding foreign withholding taxes depending on whether investments are held inside a TFSA, RRSP, or taxable account. And unlike VEQT or XEQT, VT does not include any Canadian home bias, which may psychologically feel uncomfortable for some Canadian investors. Now here's the reality most people miss when comparing these ETFs. The biggest difference between successful and unsuccessful investors usually isn't whether they picked XEQT, VEQT, or VT. It's whether they stayed invested consistently for decades. Most people fail investing emotionally, not intellectually. They panic during crashes, chase hype stocks during bull markets, constantly switch strategies, or stop investing altogether because they expect quick results. The market rewards patience far more than prediction. Imagine two investors. One spends years trying to find the perfect stock while constantly buying and selling. The other simply invests into a globally diversified ETF every month regardless of headlines. 10, 20, or 30 years later, the second investor often wins because consistency and compounding quietly outperform emotional decision-making. That's why these ETFs have become so powerful among young investors. They remove complexity, they reduce stress, they eliminate the need to constantly predict markets, and perhaps most importantly, they make investing accessible to ordinary people who don't want finance to consume their entire lives. Of course, these ETFs are not magic. They will still experience crashes, recessions, bear markets, inflation fears, and periods of uncertainty. There will absolutely be moments where portfolios drop significantly and headlines scream about economic collapse, but historically, diversification diversified global markets have continued growing over long periods because businesses innovate, economies expand, populations grow, and technology advances. The key challenge is surviving emotionally long enough to benefit from that growth. And that's why simplicity matters more than many people realize. Sometimes the best investing strategy is not the most exciting one. It's the one you can actually stick with for decades without panicking. Whether someone chooses XEQT, VEQT, or VT ultimately depends on personal preference, comfort level, and investing philosophy. Some investors want slightly more Canadian exposure. Others want pure global diversification. Some prefer investing directly in US dollars. But all three ETFs share the same core philosophy: own the world, stay diversified, think long-term, and stop trying to predict every market movement. Because at the end of the day, wealth is rarely built through constant excitement. More often, it's built quietly through patience, discipline, and consistency repeated for years. And in a world obsessed with quick money and instant success, that may actually be the biggest investing advantage of all. If you found this helpful, consider subscribing to Wealth Narrate for more simple, long-term investing insights. And drop a comment below. I'd love to know which ETF you're leaning towards and why.